going to be talking about inflation and the impact on the real estate market, the economy. And we're just going to have a conversation, a little bit different today, no presentations, but we want to talk about what's going on, in the economy. And while the stock markets would hit 30,000 and, real estate home prices are going up, commercial is different, meanwhile, it's some headwinds in the future for us to talk about, man. So for many of I'm Steve Peterson, broker owner of Infinity Investments. Been in the commercial real estate business since 2003. We started this company in November 2009. I got my boy Jason Matthews of Matthews Financial. We basically started the companies around the same time, right? Around like 2009, 2010, right?
Last time there was blood in the streets, man. We're watching Mutual's closing, Wachovia, Bear Stearns.
All of them, man.
We jumped in the deep end without a life jacket, man.
And that was really the best time to kind of get going. If you think about it, that's really the when you want to start a business, when you want to get rolling with anything that you're doing, when you can get going in a time of crisis, that's like the best time to do it. You know what I mean? And I think that I always, in the last couple of years, I've been talking about time in the real estate market. Where are we at in the market? Are we at the top? Are we moving around? And a lot of real estate people, oh man, don't be negative, man. Just, the market's rolling, let's get this money. Like my take on it is, I keep a positive outlook on everything. I want to be realistic about what's going on and identify the opportunities. And it's like, man, there's so many of them, especially when things shift up. You know what I'm saying? Now, I do think this is a different animal that we're in right now. This is a different animal with the pandemic, the quarantine, GDP getting cut down like it is. At the same time, money being pushed into society in general, I would think. You know what I mean? So that's why I've done a seminar before on inflation, like 2 or 3 years ago, man. You know what I'm saying? And we did it, together. And what was interesting coming out of the last market cycle, where it was a big bailout done like never done before. And I think this stimulus is even bigger than that. I don't have the numbers, but I'm pretty sure that this stimulus is probably the biggest stimulus in the books, right?
So the last one was about $700 billion Obama did. This last one we have seen altogether has been $5 trillion. And that's what the Federal Reserve and then what the president did. And we see that wasn't enough as there have been talks of another stimulus package back in July when the last one ran out of about another $3 trillion. But now that got pushed back because the Democrats didn't want to push it through because they didn't want Donald Trump to get the credit for it. Now we're coming back. We're hearing about $900 billion stimulus package now until Joe Biden becomes president. And it's interesting because if you look at these times of political policies, it reminds you of the Great Depression when you had Hoover as the president. So I'll give you guys some context. So Hoover was the president. Was there bad times, recession? It was weird. Bad times were happening. The Democrats would wait for FDR to become the president. So we had a lame duck presidency with Hoover. Like, we already knew Hoover was going to get fired, slap him out the way. Right. And we're going to wait for FDR, so we're not going to approve the stimulus package. Well, they waited for so long not to do it because they didn't want Hoover to get any credit for he don't have any chance to get reelected, that it made the economy even worse. So that $2 trillion they needed wasn't enough when they finally got the president they wanted back into office. And so it was a downward spiral that caused the Great Depression, was the full story. And I'm not saying we're heading towards a Great Depression, but what we do know is this is going to be a very tough winter. And the money won't go to businesses and individuals with a new stimulus package, a real one, until Joe Biden becomes in office at the end of January. So there won't be no money on the market until March and April and put many people's hands. So it's going to be very interesting how this winter unfolds, especially when unemployment benefits runs out the end of this month. The eviction moratorium runs out. The eviction, unemployment, and a lot of other programs are running out. So we're about to see how everything plays out on this winter.
Man, I mean, so that's and is it safe to say Trump is a lame duck president at this point, being that I know he's contesting everything. So is that, I mean, is that even, I've heard that said before, lame duck. You know, is it safe to say that he is a lame duck while he is still
So
contesting the
he's
whole situation?
so he's officially a lame duck president. So we're just waiting now since he lost these other states. I know he's trying to fight it, and he still has a little chance, a small percentage to winning. Um, but he's a lame duck president. He's not going to beat it.
Right, 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 right.
And he
And
knows. And that's why Joe Biden's putting together his team right now for his cabinet and everything. And if you look at his cabinet, if you pay attention and you figure out the policy of his cabinet, it should give you an opening or a window of what should be expecting for us on a policy standpoint over the next 4 years.
Man, and I'm glad you brought that up, because I mean, changing the guard, right? Things are probably going to shift and change. And we know from everybody, I was just talking to my banker, Scott Bryant, shout out to Scott Bryant, California Banking Trust, and we were talking about the second round of stimulus. And he was saying, yeah, it's probably definitely not going to happen until after Biden's in there. And then it may or may not be a little bit different than before. It'll definitely be something that that happens. So that's a great thing in the sense of we as Americans, the people, the businesses, the main street, the feet to the street, you know, the back streets, you know, we need to be capitalized. And they're telling us to stay home, we can't do this and that. So we definitely need to be capitalized. However, it's always just like those medications, right? You ever watch a medication commercial? It's a medication. The list of side effects is usually longer than the commercial. You know, they got the commercial, somebody smiling, and then them side effects come on, and it's a whole list of them. So we want to talk today about, okay, we need to stimulate. I mean, at the end of the day, you shut down the economy, you're going to have something, you're going to need something in order to stimulate things, right? However, what are some of the negative things that we maybe need to think about, be prepared for, and how do those affect, particularly our audience, real estate market, but the economy in general? I see there's a couple questions in the chat. We got a smaller group today, so I will, let Jason kind of give us thoughts and feedbacks on that, and then we'll get to the questions as they pop up. But what do you think are what are some of the side effects to the medication of this stimulus?
Couple things. So I'll be saying that there's always winners and losers towards everything. So the effects of the stimulus package, well, first of all, there's two branches of how the stimulus happened. One is the Federal Reserve, who has the power to control and print money and interest rates. And then you have our executive branch, who decide on policies that they're going to push. But let's talk about the Federal Reserve portion. So the Federal Reserve has the power to print money and lower interest rates. So the Federal Reserve lower interest rates even further. It is great if you're a borrower because now you can borrow money at historical low rates, right? So if I'm borrowing cheaper. It's like funny when you talk to people in the 80s who talked about the first mortgage was 12, 4, 15, 17, some crazy double digit rates. And now we're talking today where people are talking about getting below 3%. So it has been great if you're leveraging that money. It is bad for savers. It's bad for a couple people. It's bad for savers, one, because your interest rates are so low and you're trying to be conservative. It hurts you because interest rates are so low. So that hurts people who are savers, it hurts insurance companies, and also hurt pension plans. And the reason why is pension plans supposed to have a certain amount in equities, and real estate, and another portion of bonds. As interest rates go down, your safe money or bonds on that interest rates values drop as well. So that means that pension plans has to be a lot more aggressive towards those plans. Also, because of the historical trends, not just now, but if we look at the last 20, 25, 30 years, we've been having a historical trend of interest rates going down. What we have seen, and you can go to a great website I always tell people to go to, is usdebtclock.org. Income has stagnated in America, but assets has been growing drastically in America, right? So we go to U.S. debt clock. In 2000, I believe that median income is around 30,000. Today, the median income in America is 34,000. Back then, home prices was about 135,000. Now they're 360,000, which is all government stats. So those are the drawback of low interest is people are savers, are conservatives, and pension insurance companies are who are normally people who are safer people are have to over leverage themselves and they're not getting the return that they're normally used to on the money. While people who are leveraging themselves are totally winning from it. Also, the American consumer in certain things are starting to see inflation on certain items because of policies. So, for instance, we see inflation at the grocery store. That's not counting. We see inflation with lumber. We see inflation from us buying hot tubs and everything else. And the reason being is that warehouses can't have as many people as they normally do, and they have to put additional restrictions and safety measures in place. And to due to those safety measures in place and less people working, there's less things into the market for those things. So the prices of those go up as well. So we're seeing inflation because there's less supply of those items. So those are a couple of things we're seeing right now.
Man, and you mentioned something that sticks out. You mentioned insurance companies not being affected by this, and that's interesting because a lot of it, in fact, I think insurance companies are the largest lender in the commercial real estate market. And if they're not the largest lender, they're definitely up there. I think that grouping of capital is probably the largest group of capital that is deployed in commercial real estate. And right now, lenders are making loans, but it is very tight. The loan to values definitely come down on a lot of different product types, and the debt coverage ratios have gone up. The ratio between the net operating income and the annual debt service, that certainly is a lot tighter. So the bottom line here is that, when you mention insurance companies being affected by it, I was like, well, that may have something to do with their ability or their desire, maybe not ability, but their desire to make loans out in the marketplace. You think that has any correlation?
Yeah, definitely. A couple things. So low interest rates have, first of all, when we talk about insurance companies, we're usually talking about life insurance companies, not your PNC companies who buy commercial real estate. So low interest rates hurt them a couple things. One, because of COVID, they didn't know what was going to be the risk mitigation on how many deaths they're going to have on their books from having people pass away from their life insurance portion of their portfolio. Number two, interest rates, and so it's multiple things hurting them. So that's one thing that they have to measure for. So we have COVID, all those people going to die for, so we have to figure out how much risk that is. The second thing that happened as well is due to low interest rates, now we're hurting because our chastity on how our basic thing of life insurance, your whole life insurance and everything is based off of interest rates. And we still have to keep the promises we made as far as paying out a dividend on those policies. The third thing is we don't know how commercial real estate is going to be with so many companies who are laying off people, who are downsizing their companies and people working from home, which I see a perfect example of. My brother works in tech, and he talks about how he's not supposed to go back to work till July. Had clients who work for LinkedIn and they're saying, hey, people, we don't know when we're going to reopen. So these corporations are saying we're going to downsize. We don't need all this space. I listen to AMG as well, a theater who's bleeding cash out the yin right now, and they're saying 50% of movie theaters are going to close. So they're knowing that they're going to anticipate all these losses. And so what they're doing is they have to be a lot more conservative with their funds because they know they're about to have tough times ahead. I know Transamerica, Jackson National, a bunch of tons of insurance companies who have actually had layoffs themselves over this year. It's crazy.
Interesting. And how does, if at all, the virus, like you mentioned, like risk of loss with this virus, does that affect this, especially the life insurance companies? Are they, is this affecting them and their not ability to pay out, but their just outlook on things, being that, hey, we have a lot of our money, that may be in, at risk, and then we may be looking at having to pay out more in terms of more people passing away. Is the virus at all a part of their calculations with, on the straight up life insurance piece?
At first, it was. So when it first came out, we didn't know much about COVID, and so insurance companies were getting for the underwriting was getting a lot tighter and restricted with their underwriting. But since data came out for them, they opened up their underwriting a lot more open for insuring people. So before they was limiting their insurance, when I say tighter, they were saying anybody above the age of 70, then we're not going to insure. If you had some any other previous health issues where we would consider it, now we're not going to consider it. But for the most part, most insurance companies open back up. Because here's what the thing about: even though COVID has 200,000 some deaths in America actually been flatlined and declined this year in America. And people are like, how is that? People not on the road, so there's no car accidents. You have all these other ways that people die are not actually happening on a day-to-day basis. So the actuaries there, so they had to recalculate the actuaries and say the numbers are people are actually not dying the same with COVID or not with COVID. And COVID is still not the number one way people are dying in America. It's the third leading cause of death in America, and it's a far behind from heart disease and cancer, right? So
wow, say that again, man. So it's far behind. What are the first two ones?
Heart disease and cancer are still the two big time leaders of that. And you could go to the CDC for that. A huge amount. So we talk about 200,000 people dying from COVID. But look at people with heart disease. I think I posted on Facebook last week. There's about 600,000 people died from heart disease so far. 400,000 people died from cancer. So COVID is actually way behind.
600. So wait a minute. So 600,000 people have died this year of heart disease?
Yes.
Man, I mean, just to think about that for a minute, because some heart conditions are, inevitable, but a lot of that has to do with the way we live, what we eat, how we take care of ourselves, the stress level. And I would imagine that the message is from the city is stay home, quarantine. What I'm not seeing, what I would love to see more of, is the emphasis on actually being healthy, not just avoiding the virus, being healthy, eating better, boosting your immune system, exercising. Because when you just mentioned, I didn't know that, man. That heart disease, I knew it was a problem, but I didn't know it was the number one cause. 600,000 people is a lot of people, and that's something that we oughta. I mean, that's I don't know if that it ain't a pandemic, but it's something.
Right,
man.
But if we look at the COVID, right? This should be a lesson to America because the people are dying from this, right? I look at the California numbers all the time when I have a conversation. But 85% of the people who died are 50 and above. Died. Young people are dying. I think only two kids below the age of 17 have died from COVID, right? Younger people are catching it, but they usually they have better immune system. But the lesson should be made that COVID should teach us to take better care of our health, to exercise and to eat right. The people who are younger who die from it usually, not always, but usually have some premeditated issues. They had diabetes or I have some issues. And with this, it just kicks it off. So I think this should be a lesson to be learned. It's not just wear a mask, but eat right, take care of yourself, build up your mental health at the same time, and you're still learning how to manage stress so you can have a strong immune system. I think that's huge.
Well, I mean, we talked about, and I'll get to one of the questions right now, but we talked about what are some of these side effects from the pandemic, and not just the virus, but the whole pandemic. You mentioned mental health, and I know I'm not a psychiatrist or nothing like that, but I can only imagine, the isolation that's going on. And like isolation just is not the best, especially for kids, but even for adults and older, younger, whatever. Those are some issues, and our kind of topic, we're talking economics, but I think everything comes into play when we're talking about it. And that's one thing that I think that, the mental health piece is critical. And I got a team of real estate agents. What we talk about is, keeping the positive, feeding your brain with positive content on a daily basis as our battle plan of how we're going to go out in the marketplace and serve our clients and do the best that we can for our families. We've got to, if we're going to do that, got to constantly be filling our minds with positive content that's going to help us out. And, that's just, from a business standpoint, what we're trying to get accomplished. And I think that when you look at it as a country, like what you said, that there's some lessons to be learned. We have to be more healthy as a country, mentally, physically, in all these different ways. And to that point, Reba Middleton, what's up, Reba? I see you out there.
Hey, Reba.
Reba, Reba asks, people keep asking about rents. I notice people moving, but haven't personally seen rents decrease much. What have you seen? Well, let me give you here's the deal. Okay. And I know, especially Reba, you in San Francisco, rents have come down quite a bit. I've got a good client of mine. He has buildings in North Beach. And he was saying, I think it's like a one bedroom or studio he used to rent out for 4,400. He's now renting at 2,700. I think that a lot of the rent loss is going to be at the higher end. Here in Oakland, you are seeing on the market rate in the higher end rents coming down, because a big part of that has to do with the supply that's hit the market. There's been a lot of brand new buildings hit the market kind of at the same time during this pandemic, and there are people moving out. There's always people be moving out of the interior Bay Area. It's expensive. We're not getting a lot of people moving in right now, which we typically get. And Oakland gets a lot of people who are always coming from San Francisco. Well, the people who are moving out of San Francisco, they're not going to Oakland. They're going to other areas, outlying areas. They want more space. So this idea of more space is, kind of what's driving people moving out of the central business districts. Now, is that a short-term thing or a long-term thing? That remains to be seen. Subsidized rents, Section 8, VASH, which is veterans housing. Those rents have not come down. And actually, if you have Section 8 tenants, if you have VASH tenants, if you have any sort of subsidized tenants, not only have those rents not come down, those rents are getting paid like clockwork on the first. So over the last few years, I've seen a lot of people say, I don't want to do Section 8. We don't like Section 8. We don't want to do Section 8. Now is a good time to have Section 8. And just like any other tenants, you have to screen them. You've got to make sure they're going to, they make it through your screening process to get to your building. But those rents have not come down. Those Section 8 is playing like clockwork, and they're a good alternative. But rents have come down. Now, I don't know though. I think this is a skewed. If I've heard as much as 20-25% in San Francisco, but I do think that's skewed because this whole year is skewed, meaning that it's out of the normal. It's an outlier. Doesn't make any sense, and it's also a temporary situation. Imagine if you're paying $4,000 a month on an apartment in San Francisco, and you can't go to your favorite restaurant down the street, or you can't go to any restaurant, or you can't go to a movie, or you can't go to the bar, or you can't go to you like, why am I paying $4,000 to look at these same four walls when I can go way out to Antioch, Brentwood, something like that for $2,500 and have a yard and have space. So, and like when you were talking about, Jason, like tech workers, like, you were saying your brother, they being told, no, don't come in. We're going to hold this thing off to as long as we can. You workers work from home, do what you got to do. So that means it's like you can move out and get 3 times as much space and you don't have to go in. A lot of that driver of living in San Francisco and living in Oakland is I'm close to where I have to work. I'm close to my lifestyle. So I'm hoping and thinking that this is a temporary blip. I think like a city like San Francisco, people gonna always want to be there.
It depends though, Steve, though, right?
It depends though.
Rents and the 80s, remember, was a crazy time in the city. And there's an article about rents on November 3rd from Wall Street that follow a lot. So I think a lot of it is going to depend on our policies going towards COVID and how we treat our business community right now. Because you have like a huge tech investor VC who's saying I'm going to Texas. So if we don't make a positive business environment, the 49ers not playing out here, right? They're playing Arizona.
Well,
right?
On that note,
Oregon.
And that what you just said, see the Niners, and I'm a Raider fan, by the way. It was tough week to be a Raider fan. You know what I mean? But what else? Right? What else? But the Niners are being told they cannot go not even play. They can't practice at their facility, which first of all, the NFL protocols are so strict and so stringent. It's way more stringent than if you and I go to the grocery store, right? We have a much better chance of getting this virus going in the grocery store than the NFL team has. Yet and still, County of Santa Clara has told them, no, y'all got to get out of here. And so they're going to figure it out. They're going to do what they got to do. But what you brought up is a point, and that's why it depends whether this is a short-term, flight or this is a long-term flight. Short-term, yes, of course. If you can't live your lifestyle of the San Francisco or downtown Oakland lifestyle, and you don't have to go to work there, short-term, yeah, why would you pay that? Doesn't make sense. Long-term, like what you just said, is the key is, are we as the city governments, the county governments, the state governments going to be welcoming our businesses and business people back into action and allowing them to do business? It's already, we pay the highest amount of taxes probably anywhere. Maybe there's in Hawaii, maybe they pay more than us, but we pay as many taxes as you can pay in the state of California, in Oakland, in San Francisco. And so it's already tough to do business. And so if a couple major, employers say, you know what, I'm going to move my headquarters to Texas or somewhere else, that really could hit us, because what happens is, people follow the herd. So if they do that, other entrepreneurs are going to see the same thing. And what they're all saying is, if I got prime time commercial space downtown, I'm gonna walk on my lease, or I'm gonna renegotiate that lease, that landlord. And we've seen a lot of that. We've seen a lot of people walk on their lease, and we've seen a lot of people renegotiate their lease. I think a lot of smart landlords are renegotiating. They'd rather have them in there at a discount than not having them in there and trying to go find someone else. So remains to be seen. But to answer Reba's questions, in the interior Bay Area, rents have come down. Now, I will say this: I'm doing a lot of business out in Stockton. I have not seen, although I don't have any properties that I'm renting out, but I'm actively working on apartment building deals, a few of them right now in Stockton, and I have not seen a drop in those rents. However, I'm not working a lot of Class A high-end marketplace, whereas that is kind of where we're seeing the drop in Oakland and San Francisco. But Oakland, it's a double-edged sword, because we've also seen all these buildings hit the market at the same time. In a regular market, when a bunch of apartments hit the market at the same time, there's going to be some flattening out of the rents, maybe a decrease, because you got extra supply and those units got to get filled up. They're not getting snapped up like hotcakes. So that's, you are seeing some a decrease there, but it's not dramatic. It's not really hitting that much of the middle of the road or lower income areas. And a lot of those subsidy rents are paying at or more what they were before. So it is a balance out there. And for landlords, I think the bigger thing is figuring out, okay, getting back on the inflation discussion, is collecting your rent, making sure you're creatively able to collect your rent and keep your relationships good. But then also, I think, and let's talk about this for a minute, is keeping your expenses down. And the thing about inflation, as I've read and studied, a lot of inflation can be the real estate investor's best friend, but it also can be a double-edged sword, because you like what you mentioned, you lock in low interest rates, long-term interest rates on an asset that you're buying, and then inflation ideally gets the rental amounts up. The question is, and the issue is, the expenses, and will your expenses grow at a faster rate than your income? And in a rent control market, that can be a challenge. So if rents are flat market wise, or if you're capped on what you can raise your rents to, but your PG&E bill is up, your material cost is up, if everything's up, then that affects you. So what do you think, Jason, in terms of operating expense? Like for in a building, you're gonna have all kind of material costs, because you got to turn units, paint, sheetrock, wood, all kind of different just materials, utilities, all these types of things. I think that's the biggest concern for real estate investors and business owners that have to operate business where there's a heavy amount of cost involved. I mean, what do you think we'll see over the next couple of years with the cost of doing business as it relates to inflation?
Yeah, there's a couple when it comes to inflation, especially when we talk about real estate. Um, One thing I know you've been talking, you made some great points on property and employees. If I'm for safety for work, I'm going to have to ask for safety measures when I'm going to pass down those costs to the landlord, and the landlord supposed to pass it down to the tenant eventually. But one thing I think is we're not talking about or is what's going to be the effect on taxes on property owners with the deficit at the state, county, and city level, and that's in the services you get from it. So what is going to be very interesting is the state is revenue has dropped drastically,
Yeah,
about 40%, and they're already been furloughing already. And remember, the state calendar year is they do a fiscal year from July
yeah.
1st to June 30th. What's going to happen to landlords on properties when we say you have deficits more? They're going to lay off more police, so you're going to have to pay for additional security, which is another, I guess, the cost of doing business, inflation. Are you going to have to pay more in property taxes, or are they going to try to increase property taxes more? How is this outlook is going to look like with the state and city and local and all local municipalities? We're going to have budget deficits due to COVID. It's going to be very interesting down the road.
I mean, you just brought up a good point, man. I really haven't thought about that, but the state, you just said that, so the state is down 40% on the state's revenue. Is that what you just
Right.
said?
Correct. In San Francisco, when Reba asked about San Francisco has $1 billion shortfall in their budget.
Man, that's crazy. Well, I
Crazy.
mean, yeah, and that's like the tourism capital of the West Coast, not of the country. And, I mean, that's so big, and San Francisco recently has got the tech and all that stuff, but the San Francisco, authentic San Francisco, has been the restaurants and the tourists and the financial district and people, the businesses, the tangible businesses. And those are a lot of the businesses that are just hit by this thing. You know what I mean? The tech folks can just work from home, you know what I mean? But the restaurant that's been there forever, and I know everybody in the Bay's got a favorite San Francisco restaurant. I love that. I think it's Espita's, the Brazilian steakhouse. That's my favorite San Francisco restaurant. If people come from all over the world to go to restaurants here, man. And those are the type of businesses that I worry the most about, because even if they're able to weather the storm of getting through this, then they at some point, we as business people, we're going to have to deal with increased costs at some point. I mean, you mentioned taxes, and you'll probably have to pay some more taxes. Whether that's property taxes, like in Oakland, the city of Oakland business tax. The reality is, hopefully you can't squeeze blood out of a turnip. And so we done went through all this stuff. But the government, especially in California, they're expert at taxing people, right? You know what I mean? You talk to people. My sister live in Florida. She always tell them, why don't y'all move to Florida? You got to pay all them taxes. You can buy a house, 200,000-300,000. You can do your investments out here. So it's, but it's home, right? And we're gonna fight for it. We're gonna make it happen. And I think that for landlords out there, you got to bear down, man. You got to bear down. I think from a lot of my clients, by the way, a lot of their tenants are paying. And there's always a couple people not paying in general. But a lot of people are able to work things out with their tenants. Now, we track defaults in my office. We track residential defaults, 2 to 4 unit defaults, commercial defaults. They're up. But I will say this: before the pandemic, there were 166 residential defaults in March, and the pandemic bailed a lot of folks out. Now last Friday there was Friday before Thanksgiving there was 61. The Friday before that there was 54, so there was an increase. 2 to 4 units, there's like 17. Commercial, there's like 17 in the city of Oakland. So they're up since the courthouse opened back up. But we expect to see more, and that is just a part of this whole thing. And for the landlords out there that are struggling to make things work, the last thing that they want to see is the cost of materials skyrocket, and more taxes to pay. You know what I mean? So I think hopefully the governments will be inviting to businesses to continue to operate here, to not squeeze us so much, the economy is going to need taxes from somewhere. And nobody wants to, nobody wants to pay extra taxes. But when you say something like we just lost 40% of the revenue, and every year in California, it's a fight, a negotiation for the budget, right? I mean, every year that I can remember, I know they've been doing better the last few years about negotiating it on time and not having the delays. I remember in the Gray Davis years, early 2000s, and when Schwarzenegger was in there, it would be weeks and weeks at a time where they haven't approved the state budget yet, and that could put a lot of programs in jeopardy. And when you mention that we're down 40%, they're probably gonna hit us with some more additional taxes. But I hope that they don't, to the extent that we lose more people and more businesses, because we got to keep open. And there's a lot of different talk about, are we being too extreme with the shutdowns? I think we are. A lot of people think different. My wife is of the totally different. She thinks we should be all the way shut down. So everybody has these different competing factors. But in the business world, I mean, 40% revenue of California. You can just imagine what is the revenue loss of all the businesses in the Bay Area. Just if somebody did that, I mean, I don't even think you could do that calculation, but I mean, it's got to be in the trillions, right? I mean, and whatever stimulus money was stimulated still wasn't enough to equal what we lost, and going forward, I think let's talk about this. Okay, let's say we do see more taxes. Let's say we do see inflation or hyperinflation, right?
Let's hold on before we start that, Steve. Let me put a prerequisite towards everything. There's no such thing as bad news or good news. News is news. Everything is always in the eye of the beholder. Yeah. Recessions and downturns can be an opportunity of a lifetime for people who are prepared and educated and willing to make those moves for the riches and glamour that comes with it.
Yeah.
Downturns are bad for people who are not properly prepared. And I think what we're having is in this bull market since 2010 in the equities market, real estate market, is people got so excited over the last 10 years of we can always make money in the market. We forgot the lessons of 07, 08 downturn. And I don't care how good you think you fancy you are because you got Tyreek Hill or whoever your star wide receiver is fast and quick, or you have this fancy offense. If you don't got your fundamentals, it means nothing. And so people who are ready, who prepared, who got their foundation fundamentals down, they're going to win. It's crazy. I was talking to somebody before about what made De La Salle football great in his prime. And I remember back in the day, Skyline had more D1s usually every single year than De La. But what De La had, they had a couple star athletes. You had your DJs and your DJs, and all that. And all my boys, Eric Carey and Maurice Jean-Drew, they had a couple super athlete brothers. But what's the key was that they were disciplined. And so when you play all these teams with stars and super athletes that were as disciplined. So I think if you're the disciplined person, you're educated, you've been doing your job, and you've been running your numbers and not being the herd mentality, you're going to be okay. And matter of fact, it's going to be an opportunity of a lifetime for you. I just want to say that before you go into
Well, I'm glad to hear you say that, man, because it's always about the blocking and tackling, the fundamentals, the rebounding, the free throws. You know what I mean? And the catching and throwing in baseball. I mean, whatever the fundamentals are, that's what you got to master. And I think that, to your point, for the businesses, for the people, for the organizations who are fundamentally sound, you're able to weather the storm. And in fact, more than weather the storm, you're able to really prosper in these times. And I think that's the consistent message is, let's not be naive to what's going on, but let's be aware of what's going on and let's make our plan accordingly so that we can survive and we can thrive through it. Because there's always, hey man, like we just talked about, we started our companies in a Great Recession, man, and there was a lot of big companies went away, and that was a great time though to start a company, to be involved and be dialed in. And I think this time around is going to be the same thing. And so to speak to that, what are some things that business owners can do, and real estate investors can do, other just, people, who are wanting to advance and build their wealth portfolios and also protect them, what can they do in a situation where, hey, man, we probably are going to have to pay higher taxes one way or another, state and federal. We probably at some point are going to see some element of inflation. And we're going to have, I would imagine, be in a recession or in a period where the GDP is contracted for a while. What are some things that we can do to insulate ourselves against these things and actually prosper and thrive?
Yeah, definitely. First and foremost, I'll tell everybody read my book. Yeah, I was going to give you guys a couple of things. I wrote my book in 2008.
Age of self-reliance, right?
Age of Self-Reliance. You guys get on Amazon for it. But it's a couple of things. One is you got to know your numbers, right? I think during good times, we're all eating, we're doing good. We don't stay on top of our numbers as far as how much income we need to get and our budget. So stay on top of your numbers. Know how much money coming out, know how much money coming in, and make sure you have your cash flow and build up that squirrel of a nut. So the key is people say cash is king. Nah, I love cash, but it's really is cash flow is king. Number two thing, right? Cash flow. As long as I got my cash flow, I don't care. Right? People come to me with lump sum of cash and they say, hey, I just want the cash flow. So I know if I have that lump sum, I'm going to spend it or do something stupid. But if I have that monthly check coming in all the time, which we all live and die for, we'll be okay. We'll be all straight and we can weather the storm. Number two thing, educate yourself on what other people have done that have been successful during this period of time as well, which means we say cash flow, find properties, you do real estate, do other things that are positive cash flow. And when you do your numbers, don't be too aggressive with your numbers. Understand what a decline of not having, I don't know what realistic number, not having your rents come in, but even if those rents don't come in, make sure it will still provide you positive cash flow, which means you got to do proper underwriting of your real estate deals, your stock deals, and your retirement, in any of your retirement plan. Third thing is always tell people reverse engineer what you really want. Right.
Yeah.
And once you do that, once you figure out what you really want, reverse engineer. Once you reverse engineer, you should look at what's going to be your stumbling blocks, what's going to be your hurdles, your speed bumps on your way to get whatever you want as well. To counter inflation, you want to look at things. You want to have 3 to 6 months in your savings account, but after that, you need to look at where can I be more aggressive? How much more can I be more aggressive that can beat up or keep up with inflation for those goods? With inflationary periods, take advantage of these low interest rates. Lock in long-term short rates. I think they're going to be long-term, short-term. I think for the long term, we're going to have low interest rates for until we can see it forever. We're not going to see higher interest rates. Now, when you talk about what the Federal Reserve raise taxes, I don't think so as much. But what we will see, though, is we're going to get ready for this. Less deductions. So to certain things that were deductible, they won't do that, and they'll tax increase us because they know that they won't get reelected if they increase taxes, but they will get rid of deductions and make it sound like it's not. So for your taxes, for Social Security, the same way. We saw that when they did the budget in Obama administration in the middle of the night, where they signed the budget and they got rid of loopholes for Social Security. So get ready for those things. So stay astute, stay in your local politics. Push your politician for the policies you want. Because, we talk about increasing taxes, talking about cutting services, but we're not talking about how do you grow your way out of it. And that's one thing I think we need to talk about as well for pushing our politicians. Like, how can we grow our way out of this?
Yeah. And you mentioned a good point there, growing your way out of it. And that's the one thing that I think we've been stimulated by in the last 10 or so, since the Great Recession. The economy has been stimulated. I think that coming out of this, we've got to figure out a way to be more productive, more efficient, more innovative. And innovative doesn't have to necessarily be some tech product or company or whatever. Just figuring out better ways of doing things, more efficient ways of doing things, being more productive with our time and our resources. Like which you mentioned that hey man, we might need to prepare for a tough winter. Maybe that means not going out and buying every single thing for Christmas. Maybe buckling down and making sure that you're gonna be straight. In the times come. And I know what's been weird during this time, and I know you see on Instagram and Facebook, so many people taking lavish trips, buying lavish things, and and the problem is a lot of that is not with like profits they made on the business. A lot of it's with stimulus money. And so what we want to do is figure out a way of how to be more, just productive and effective and efficient with what we do have. And everybody's got some sort of talent, skill, ability, connections. It's a matter of making those things, connecting the dots and making them happen. Everybody got a couple of dollars. What are we doing with those couple of dollars? How it doesn't, you don't have to necessarily be a sophisticated stock market or real estate investor, but you can be wise with your dollars, and you can be, calculated with the moves that you're doing with your time. I think time is the biggest asset that we all have. And, and during this pandemic, and now we're in like a second shutdown. I was like, hey man, it felt like we've been shut down the whole time. I know they opened some stuff up, but this has been shut down. What are we doing with our time? You know what I mean? And one thing I've done with my team, like we do a Friday team meeting on Zoom. And actually Zoom, this thing is help us to be more productive because we would have a physical meeting and some of the agents would come. And since we had the Zoom meetings, I get way more attendance at my weekly meetings. We got more input from the agents. We're able to go over a lot of things. And what I consistently am telling them is take this time to sharpen your axe. Take this time to get better. Take this time to figure out your strategy, to figure out your adjustments and pivots. When the Great Recession happened, I was in the office and I was at Sotheby's, before it was called Sotheby's, it was Montclair Better Homes. And this office was rolling, and they mainly sold a lot of properties, high-end properties in Oakland Hills and Piedmont and all that stuff. When the market shifted, there was only really one guy in there selling properties, and he had an REO account, and he was selling REOs. And then I had sold a property. I sold a REO. It was an apartment building. And what I just noticed about that time, then I left there and started my own company. But what I noticed at that time is that the market shifted, but only a few of the agents shifted with it. He has a lot of smart people that were making a lot of money, $200,000, $300,000, $400,000, that was just shook and like feet in the mud when that thing happened. You know what I mean? And like my message to the marketplace is stay light on your feet. Stay nimble. Don't overload yourself with too many expenses, and make sure whatever you're spending is impactful and meaningful, and it's not frivolous. You're just not throwing money out there. And that you're watching and seeing what's going on. Not like with the masses, and don't just get caught up into, real estate, home prices, not real estate, home prices are going up or the stock market's going up. But look into what's really going on. And I think you will be able to identify opportunity. Like Jason said, in these times where a lot of the biggest businesses were started and a lot of the competition is going to fall off, this is where it's your time to shine. If you're a real estate investor and you've been patient, you might be able to actually negotiate on a deal or two. Imagine that. A lot of times in the last few years, you've been having to overbid, but you actually, on a commercial property, on an investment property, you might be able to negotiate. Now, homes are different. We're not talking about homes, but that's a different marketplace. And that marketplace has continued to skyrocket. I don't know how much longer that's going to be, but I mean, for the meantime, it has shot up because you get 2% money on your mortgage money. So it makes sense for sure to buy a house. And now your house is a school, is a gym, is an office. Your house is inherently more valuable because you do everything from your house. You know what I mean? you know what I'm saying? It's a restaurant. It's a playground.
Honestly, hey Steve, I was getting back to going to the gym a couple weeks ago, and then shut it back down. When you talking about your best time, I was like, I started doing like everybody else, start binge watching, watching a little bit more Netflix late at night. Nothing's open, so I can wake up whenever. But then
the thing about exactly.
And I got better though. I was waking back up at 4 a.m. So what I did this month, I'm like, all right, gym is closed. I'm about to write my second book. I'm about to do myself a 31-day challenge where I'm going to write 31 chapters, write a whole book in this whole month. But I think, like you said, you got to be disciplined with that time. Like, what are you doing? You just watching Netflix, like you said, and getting fat like a lot of us been? Or you still trying to figure out how to work out outside? I've been cycling, but we always can do something. Don't let.
Well, I mean,
and go to businesses don't mean you can't do nothing outdoors. Remember that.
We all can do something, and that's I think the gym is an essential business. By the way, I really do believe that. I know the state don't believe that, but I think like what you just said, so many people, and then what you just mentioned, 600,000 people die of heart disease. We got to stay active. You can't just sit at home and stay away from the virus. That's not necessarily being healthy. That's staying away from the virus. But if you stand at home binge watching and eating horrible food and not moving around, that's not really healthy. And one of the questions was said, Hinton, what's up, said, what's going on? Said as he mentioned about suicides are up, mental health is a big issue. How will these changes affect our buyers and sellers? And I think in the marketplace, it all has to do with psychology and people's feeling. So in single family home market, people are feeling excited about going out and buying a home, and maybe a little bit more aggressive because the interest rate is so low. It's dry, and then home is so valuable. People are saying, I'm at home. The one thing about being at home a lot is you can realize. I know for me particularly is, oh, look at that wall. We need to do this. Oh, look at that bathroom. We need to change this bathroom. Being home more typically will make you realize things you don't like about your home. Hopefully, also things you do like about your home or your apartment. But what happens is that's driving a lot of homeowners to go buy go buy another home. For investors are not as optimistic as the home buyers just in general. Investors are more pessimistic in general because they deal in risk. And with everything going on in the marketplace, they're not as optimistic. You know what I mean? And I don't think, for the entrepreneur who's out there willing and dealing and moving in the marketplace, their routine is off a little bit. The marketplace is off a little bit. So they're pricing in that risk. Now, stock market, I'm not a stock market guy, and maybe you can put in on this, but the stock market has been rolling. I mean, the thing dropped down under 20,000, and then it's back at 30,000. I mean, that's roller coaster. It probably don't subscribe it. When this first thing hit, it crashed down under 20,000.
But guess what, Steve? It doesn't make any sense. All right, let me say this. We're in two Americas right now. But a lot of this stuff, right, we're in two Americas where you have Americans suffering. You got way more people who are homeless. You got people with income stagnant, and you got a group of us who are doing quite well. And we're getting in two different Americas right now.
Yeah.
The stock market is not a reflection of the economy. Right now, the stock market is a reflection of government policies, not the economy. And I tell you what, with the new presidency and people getting there, we're going to have a continuation of the policies. Now, will these policies continue the stock market going up? We don't know, but Janet Yellen, she pushed QE and she just got announced as Treasury Secretary. We know she did low interest rates. Well, can we keep it up forever?
Hold on one second. I got to plug in my laptop before I lose you. Hold on one second.
We don't know. We don't know. But what we do know, we're in two different Americas, and we know the stock market. Here's the thing. Not all companies are doing well, Steve. There's only a few companies who are actually doing well, who are dictating the stock market or equities market. It's not all of them, but it's only a very, very few. I think a very few of them, once again, who are dictating and controlling the market. But we're also saying for businesses, we're going to have a record number of businesses who are filing for bankruptcy. Let me even say that again. We got a very few. When I say very few, maybe 20 companies who are dictating the stock market. But we're going to have, I'm about to go to usdebtcloud.org while talking to you guys. We have, I don't want to tell you guys, we're going to have this year the number of bankruptcies. Right now, we have 856,000 bankruptcies, which are government numbers, and 355,000 foreclosures in this country. So what I'm saying is we're just in two different Americas. That's all. We're just in two different Americas. Now, can those companies keep up? I think some of those companies will, but not all of them will with this growth of the stock market. Zoom is going to continue to be great right now, and Peloton might continue to be great. But at the same time, we don't know if Planet Fitness is going to stay open during this. And we know our fitness already filed for bankruptcy. Right. And we know Nordstrom's is going to be suffering with California shutting down. Remember, we're the seventh biggest economy or fifth biggest economy in the world. So, like I said, we're in two different. And then when we talked about tech, but not all tech makes money. And remember the fourth quarter last year, there was a huge amount of tech companies who were having layoffs and were struggling. right? But there was some that were doing great. So I remember I met this girl. She had Zoom Pizza. She's a young black girl. She raised hundreds of millions of dollars for Zoom Pizza, and they filed for bankruptcy last year. You had that purple mattress coming from bankruptcy. There was 17,000 companies, startups who did layoffs in the very beginning of COVID.
That's true.
In the fourth quarter, what people have realized is after the WeWork fiasco, where WeWork was supposed to be the super high company and it collapsed, the startup money dried up last year in the fourth quarter, but nobody really talks about how much all that startup money dried up. So the valuations cut back. And what I see happening is you got companies like DoorDash and all that who see this gap to try to raise more capital by going public. They want to deal while the window's open. But I don't think this window's going to last forever. That's my opinion on it.
Yeah, and I'm glad you brought that up because the stock market, home prices, is not necessarily, not an indicator of what's going on with the economy. That's why we want to have this discussion and talk about kind of to drill into it and what's really going on. And, like what you said, there's a couple of companies that is really driving the market for the stocks. And for home prices is this low interest rate environment and the demand for homes that is really driving prices. So we're not saying don't buy stocks. We're not saying don't buy a house. I think what we're saying is to be wise about what you're doing and to plot out your move and to make your plans accordingly, to use leverage to your advantage, but not to over leverage yourself. And as an entrepreneur, to stay vigilant. The one thing I hope we'll see out of this is more people become entrepreneurs and business owners. I hope and pray that we'll see more people just looking and saying that, hey, I can take things in my own hand, like your book, The Age of Self-Reliance. I think we do need to be more independent. I've always thought that that's just kind of the way I think, but I think as people in general, we need to take that stance. And being small and independent is not necessarily a bad thing, because when these pandemics hit, you are a lot more nimble than a lot of the bigger companies. And that's what when the market crashed last time, the Great Recession, what I saw as the opportunity for why I started my company was a lot of the bigger companies were carrying a lot of overhead and had a lot of agents, but there was just a lot of turmoil, and the bigger you were, the more complex and complicated it was. So you have an advantage being small and nimble if you have the right strategy, you have the right team, and you work it to your advantage. And I want to say, continue to feed your brain with positive instructional content that's going to inspire you, drive you, motivate you to have the daily disciplines to move your business, your family, your whatever you're doing forward, because that's what it's going to take. And I don't think, I think we're going to be in a tough time that, being in this state where we can't go and do everything. We can't. It was Thanksgiving. And I know many of us may have seen some of our loved ones. Many of us didn't see our loved ones. That has to be tough, especially on Thanksgiving when, the biggest thing I love about Thanksgiving is, well, outside of the food and the plates, I love that. I ain't gonna lie. Yeah, I love plates, but it's family and getting together and fellowshipping and that's tough because we're not able to do that like we are. It's tough, like when you mentioned the gym, not being able to go to the gym, and there's so many people that depend on that. You can work out at home, but the level of discipline and self-motivation you need to have to do that is a lot higher than if you just walk into 24-hour fitness. You walk in there and there's fitness in the air. You ready to roll. You know what I'm saying?
Especially when it's cold outside now, man. Especially when it's cold outside this winter.
It's hard. And so y'all hang tough out there. I hope this has been helpful. Please, can you raise the book again, Jason?
Yeah, definitely.
Support this brother and educate yourself, man. Age of Self-Reliance.
And one thing also to talk about being quick and know before we go, Steve, is remember Vietnam War, right? Yeah. America just came off of World War II. We was the biggest, baddest military in the world, right? Right. We didn't have any destruction like you saw in Europe and Russia. We had the economy and everybody was the leader in it. And then you have Vietnam with the Viet Cong who didn't have the technology, didn't have the military or anything else like that. But guess what they had? They were small, like you said. They were nimble, and they were creative. They went inside and they made tunnels underneath the ground so they could come and be a couple of them and they shoot us and kill us. They put together creative strategies in guerrilla warfare, which we now are famous because they're quick, they were nimble, and when that happens, they're able to be creative. And at the end of the day, America didn't win that war, right?
Right.
America didn't win it. And no matter how well, even though we say we're the leader, we never lost a war. But guess what? We didn't win it. And that should be a lesson for all of us when learn about being creative during the period of time, or during these periods of time, being nimble right now. Eventually you'll get big, but take advantage of these times to be quick and nimble.
I mean, that's real talk, man. And I think that's what we have to do. Make the necessary moves to move your family forward, move yourself forward, your career, your business, whatever it is that you're doing. You know what I mean? And by the way, lend a helping hand to somebody else. Each one teach one. You know what I mean? I think we got to do that, y'all. And make sure that, hey, like what Jason said, there's no necessarily bad or good news. It's just information, how you respond to it. So as we get some stuff that are way ahead, it might be tough, then we just got to respond to it in a way that is that's going to move things forward. You know what I mean? And I think that's the biggest thing. As we, in the state of California, it's going to be tough. It is tough. And a good economy is tough because everything's expensive. But you can do it and put your plan in place now for the next year. Like I'm telling all my real estate agents, by the time we get into 2021, I want to know what your goals are, your plan of action, your schedule is going to look like. Not like in 2020. I want to know what that looks like before the end of 20, or not what in 2021. I want to know what your 2021 plans are before the end of 2020. And then we're going to go into next year as a team, energized and together, and we're going to band together. So I would hope that y'all do the same. Stay tapped in, to this content. Me and Jason, we back at it. We talked about Matthews. We're gonna do a lot more of this type of content next year on a regular basis because we gotta, me and Jason have the same kind of philosophy of education as part of our marketing plan and part of our building our business. And we feel as though we educate the marketplace. We bring value to the marketplace. We're gonna end up doing business, and it's worked, right? The last 10 years, come the ups and downs and all arounds, man. We still in this thing, and still making it happen, man. So thank you, bruh, for coming on again.
Definitely.
You guys,
We're like stupid Dre
tap
together,
into that
man.
book. Yeah, man, we got to get out there, man. It'd be good to go hit the gym. You know what I'm saying? Do something. But let's just, let's stay. And you guys, if you're at home quarantine, stay active. Whatever you do, if you get on the Wii Nintendo and play tennis, just do something, y'all. That's 600,000 people dying of heart disease. That one, I didn't know that, and that one hit me. So just make sure whatever the economy is doing, that you stay active and you stay healthy.
Yeah, very true.
All right,
Thanks again, Steve. Appreciate it, man.
Hey, as always, bro, we're gonna keep it rolling, man. And y'all at home, have a great rest of your week. Be productive, be effective, and lend a helping hand to someone else. Peace out, y'all.